Lots of emails, Brian. Let's look in the inbox here. Tim is a real estate investor with multifamily apartments and single-family homes. He says he's amassed a wealth of over $6 million. Congratulations for that.
Good for him.
His CPA is telling him he could owe as much as $1.5 million in taxes.
Sheesh.
He says many years he doesn't even pay tax because of the losses from his farm. Says, I no longer want to be a landlord at 70. Brian, is there anything I can do to just spend my time on the farm?
Yeah, there's a lot of things you can do. You can hire a property manager. That'd be one thing. That's easy. But I don't know if you would want to do that.
But that's sucking up his profit, isn't it?
It is, but
it sounds to me like he wants out.
Out. Yeah. I mean, he obviously knows that. That's not something we usually recommend if they're in this stage of I want to sell.
Yeah, right. 70. He's ready to be done.
Yeah, and that situation probably I don't know anything about his situation, but a lot of times the family doesn't. They're off. The kids are gone somewhere else, and there's nobody there to step in and manage it that they trust, right? And they go, well, and I don't really want to pay a property manager because I guess who's got to still make the decisions.
Yeah.
Right. I've managed investment real estate before. Guess what? I had a property manager.
You're still a landlord.
Right. And they called me. They called me to make the decision when the tenant moved out and ruined the carpet and destroyed the $3,000 stove. Right. They destroyed it from, I don't know what
then why'd you hire them?
There was plastic all in. What do you mean?
Well, I just mean, don't they have the
autonomy
to make
I was living
decisions?
in Virginia and they were in Arizona.
Oh, I gotcha.
Yeah, it was long distance. Yeah, I couldn't necessarily manage it 2,300 miles away.
Right.
Don't ever do long distance investing, by the way. But here's the thing. You get to that point where you go, I don't want to do this anymore. But I still like the income, right? Because he's probably making on, what'd you say? How much is it? $6 million, yeah. The CPA said he could owe as much as $1.5 million. I mean, it depends on his cap rate, right? I mean, I don't know what he's charging, but if he's like been doing it long enough, he's probably making a couple $100,000 a year. I don't know, maybe $300,000. He's paying some tax, but he's got a farm where he's piling the money and buying tractors and equipment, and he's offsetting the tax, right? And he's got some depreciation on some of this newer stuff he's bought. Depreciation is just basically a loan from the government. You eventually have to pay it back, right? But first thing is we step into him and say, what do you want to do? Well, I just want an income stream. And it's funny, real estate investors are very conservative. That's why they're in real estate. There's actually a real estate fund that we can invest in folks' funds and do a 1031 exchange over to, and it's a huge firm. And we look at the standard deviation of that, which is the risk. Mm-hmm. It's lower than a bond fund. And because it's a commercial real estate, they got income cash flows, and going back 20, 25 years, it's lower risk than a bond, but the rate of return is over 9%. That's not what they're going to get. That's what they did in the past.
Right.
We're not saying that you should go do this.
Right.
But it's a Delaware statutory trust, right? It's a 1031 exchange. It's a simple way for him to defer the tax. It's not eliminating the tax. There's a big, big difference. So if you're deferring it, you're moving it over, but you got to do this before you close. You've got to put it in a 1031 exchange. Cost $1,000. It's not a big deal, right? To pile, if you're doing one big transaction, you're putting, let's say you got one buyer, it's buying all of it, which happens today a lot, a pool of investors. And that's an easy way to defer the tax. He has 2 kids, let's say he wants to pass it on to, he can then, pass it to the kids tax-free, assuming there's still a step up in cost basis at his death. They could sell it all. And the Delaware Statutory Trust is what? Commercial multifamily properties in Florida. It could be in Tampa. It could be in Washington, D.C., Texas, Arizona, wherever he wants, right? It could be self-storage units. It could be student housing. It could be industrial warehouses, that Amazon rents. It could be whatever.
That's a lot different kind of landlord, isn't it?
Yeah, but you're not doing it.
Right. You're not doing it. It's
passive,
Gotcha.
Right? You get a K-1 at the end of the year that flows over to your tax return, and you can get ones that say you don't need income on all of it. Let's say he's like, I only need like $80,000 a year, and I already have $40,000 in Social Security. Okay, well, let's get ones that are growth-oriented on some of it, and let's get some that are income-oriented, right? The growth-oriented are going to grow more, obviously, right, historically speaking, and the other ones are going to produce a more stable, consistent income for him to meet his income needs, right? Now, there's also, if he doesn't want to go in the real all of it, we can go into a deferred sales trust, which is basically like an installment sale of the IRS code. It's been around for a long time. And the deferred sales trust basically allows him to go into other things. Let's say he wants to put some in some municipal bond funds, or he wants to put it into, bond ETFs and go into the stock market. Once they want to buy a bunch of stock, well, he can take it from real estate and move it into that. And he doesn't have to pay the tax. It's, again, deferred.
Right.
Not
eliminated.
Right. Yeah. But all of this is very important to understand. You don't call after you've sold the property.
Right.
You call way before you're gonna sell. We should be the first person that when you start getting the inkling of an idea to sell your whatever it is, business, real estate, or retire next year, you call now, not the day before you're going to retire or sell the real estate, or the day that you're about to accept a contract, which we've had happen. They come like, I got an offer, $2 million, $5 million. You're like, what do you think I can do? I'm like, nothing. It's too late, right? Or it depends on the situation. It's not always too late. If they did do it after the fact, we can do a 1031 exchange and do a deferred sales trust. The idea is it's a little more cumbersome. It takes longer. There's opportunity zones too. That's another thing. It doesn't eliminate the tax. It just defers it for 4 more years. But the idea is there's so many things that you can do. We could bore you with all the details. In the situation here, it's all about getting back into
I'm sure Tim isn't bored right now. I'm sure he's taking it all in.
Well, and I don't know, Tim, did he say anything about charitable giving or anything? No, because we didn't ask it. We should be asking those questions on our questionnaire on our website. But if they're a charitable giver on top of that, we can mix in some charitable giving plan that everybody wins in that situation. They're able to give more money to charity that they already give to, because if they're giving to church or United Way or nonprofits, they can get a elimination of the tax by doing whether it's a charitable remainder trust, pooled income fund. They give more to the charity because it didn't go to tax, right?
Mm-hmm.
They get income for the rest of their life. And sometimes if they want, over their children's lives, if they have children. And then the charity gets the money at the end. If you want to set up something to benefit the kids, you can do that down the road so they don't get left out. Then the idea is when you're not paying tax, and somebody with $6 million, he might have other assets out there too. He might be worth, who knows, 15, 20 million or something, right? You get into that area of estate tax. Oh boy, now the government gets 40% when you pass away. So it gets very complicated, but doing this on your own, this is not for the faint of heart to do some kind of large transaction. You need a lot of advisors that will help guide you to victory by minimizing the tax, but also meeting your goals for your investments, or where do you want to invest in? Maybe he wants to go in CDs. Maybe he doesn't want to go back into real estate, right? He wants to go to something more conservative. CDs are paying 4% right now, I think, right? 4.5%, 5%. Maybe he's okay with 5% because that's not a bad return for a conservative investor right now.
Tim, a couple things. Thanks for your question, and thank you for listening, man. We appreciate it very much. You can go online to retirementplannow.com and get a lot of your questions answered right now. Retirementplannow.com.